Hey everybody, welcome to another episode of Stock Talk. This is a little video slash podcast that I like to try to put together once a week for my little corner of the hemisphere where I like to talk about all things investing, talk about what's going on in the stock market, interesting things that I'm seeing going on in the stock market, and how I'm going about making investment decisions. And really the point of it is just to share with you what I'm seeing, what I'm hearing, and what I'm doing, with the goal that you could perhaps take some of the nuggets of my thought process that I go through in terms of making investment decisions and bringing it into how you frame your investment decisions. My name is Aman, and I'm an investment coach and founder of Sage Investors. And as an investment coach, what I do is I work with new and existing investors who want to become more financially independent, but just feel frustrated, intimidated, scared by the whole investing concept. They either don't know where to start when it comes to investing and buying and selling stocks, or they've been investing for a while, but they're just not making the same traction or progress with the portfolios that they thought they would be. So what I do as an investment coach is I teach people and I engage with people on how to make better, more educated investment decisions so that they can achieve a certain level of financial freedom in their life and achieve it with confidence. So that's what I do. So this is episode 85, and today I'm kind of building a little bit on some of the previous episodes where I've talked about some of the kind of this debate that's been going on out there right now in the investment industry with respect to actively managed investment strategies versus passively managed investment strategies. With the stock market just like taking off over the last 7-8 years, the passive management investing process strategies have really taken off and are just dominating the landscape and really disrupting the traditional investment industry. And so I find it interesting. And so right now there's camps that are just kind of going at each other with, active investing is the way to go and passive investing is just, death. It's just a fad. It's not going to happen. And the passive investing say, well, look at the research saying long-term active management can't work because it's too expensive, too much overhead. There's this constant back and forth going on with it. And and there will always be going this bad. I don't think this is a debate that's going to ever get resolved. And I'll talk about it later when we talk about strategies and stuff like that. So what I'm going to talk about is I came across this article in the New York Times a while ago, and it really kind of caught me by surprise. And it kind of didn't catch me by surprise, and I'll kind of tell you where I'm going with it as we move along here. And so the article is called An Index Fund Evangelist is Straying from His Gospel. And it's about a gentleman named, if you're new to investing, you've probably never heard of him, is Burton Malkiel, and he's an economist from Princeton. And he is famous in the investing world because he wrote a book long time ago called Random Walk Down Wall Street. And it's considered one of the iconic investing books out there because it challenged a lot of notions with respect to investing, in the sense that really what it comes down to is it's really hard to figure out what stocks to buy and sell. It's really hard to beat the market, and there's no point doing it. So Mr. Malkiel has been really kind of one of the patriarchs with respect to index investing and passive investing. And essentially he's a very colorful person. He's thrown a lot of great quotes, and one quote that he's renowned for is that essentially a quote unquote a blindfolded monkey throwing darts at the stock listings could select a portfolio that would do just as well as one selected by experts. So he's very much in the camp of index investing. And he's so much so that he actually could be stated that he was actually the first person to start a passive index fund, because he got involved with Vanguard a long time ago, and he's been on the board of directors for Vanguard for almost 27 years, and he's been credited to be the founder or the pioneer with respect to index funds. And long time ago in the late 70s, early 70s, he created it. He's now 84 years old, so he's up there. But what's interesting is he's the man who's created. So he's basically pounded the table. Him, the Jack Bogles of the world, have pounded the table. And Vanguard has been, their whole value proposition is about low cost investing is a much better way to go for long-term investing. And just investing in a basket of of broad-based indexes. Having exposure to that is going to do a better job, get you better returns over the long term at a better cost, at a minimal cost compared to just trying to figure out what stocks to buy and sell. So it's interesting. Mr. Malkiel is 84 years old. And so what's happened is it seems like he's pounded the table on this whole passive investing thing, but he seems like he's changing his tune. And it's not like he's just changing his philosophy. He's actually going out there and cranking out product behind it. He's got product behind it. So what he's done is, what he's saying is that, he said in a roundabout ways, he talked about the monkeys having a better job, can do a better job than human beings. He's saying now that actually human beings can do a better job than the monkeys. And the reason why he says that is because technology has really leveled the playing field and lowered the cost, that cost differential, that gap that separated actively managed, passive managed performance and actively managed performance. And so what he's saying is that it is possible now that you can actually beat the market using some sophisticated algorithmic kind of formula and models. And so Mr. Malkiel, as I said, was on the board of directors for almost 27 years with Vanguard. He is now the chief, at the age of 84, got to give him credit for this. He's the chief investment advisor for Wealthfront, which is one of the big robo-advisors in the US. And robo-advisors are these online wealth management companies that basically have algorithms and manage portfolios using algorithms and develop asset allocations and rebalance portfolios and try to do it. And the value proposition is using ETFs, using a passive approach and a low-cost approach, and to do that and do that for people at various levels of income. And so it's interesting. He is now associated with that, and he is also associated with this new product that Wealthfront has. He's kind of given his blessing to this product that Wealthfront has introduced, and it's called advanced indexing. And so when I first read this, I'm going, it's kind of like, there's Tide detergent and then there's new and improved Tide. So it's kind of funny. It's like, well, we have indexing, but now we have advanced indexing. So it's like even better than indexing. And so what it is the strategy, as they like to talk about, is to, quote unquote, aim to exploit market inefficiencies and beat the passive approach based on an index weighted by stocks by stock market capitalization. And so many people, when I've read about this and heard about this, kind of this whole strategy falls into this element of smart beta, this smart beta low volatility kind of strategy, which has been really a big seller right now in the market. If we go over last year, a lot of money has flowed into funds, portfolios, ETFs that are promoting this low volatility, smart beta strategy, where you take, where you basically, you can talk about it's actively managed a strategy. You're defining a criteria, in this case, picking stocks that have low volatility, in which the price movements are lower than the overall market price movements. And the premise being that those type of a portfolio is going to be much more stronger, much more resilient in preserving its capital in rough markets, when the market's really in tough shape. And in the good times, it's going to enjoy the benefits, which is good, which is, ultimately as investors, that's what we want. We want to make money in good times, and we want to preserve our money in bad times. And so this has been a big, a big push. So it seems like this whole advanced indexing is Mr. Malkiel's kind of way. He's given this stamp of approval, saying this is a legitimate way to a legitimate strategy. And so it's interesting that a person who's pounded the table over his career, promoting and selling, encouraging people to be more a more passive managed investment strategy philosophy, is now saying, well, yeah, you can, but this is actually maybe a little bit better. So at first I was kind of like going to go, aha, gotcha. See, that would be my normal reaction, and I'd be kind of frustrated. But then I kind of stepped back and I said, you know what? This is probably not. This is okay in a sense, but and I'm going to talk about it as we get to some sort of the takeaways when I read this. One thing I think that jumped out at me is the fact that Wealthfront is getting involved in this. And the fact that they're getting somebody to kind of promote or sponsor or be that endorsement of their investment strategy. Again, it's interesting because this is the robo-advisor value proposition has always been about passive approach, low cost, minimal, rebalancing when you need to, and kind of not in the business of picking stocks or picking investments, but what they're doing by putting this type of product is saying that, yeah, well, they are. And I think what jumps out at me is the fact that is, there's not what they're doing, how they have been traditionally doing. They're just not making enough money. There just isn't margin. When you're managing low cost portfolios, you're not making money. You can't charge a heck of a lot of commission to make it. So it's very hard to sustain the model. So what they're doing now is you're just going to start seeing more of this, is introducing some more higher cost, actively managed kind of components into their portfolio, into their product line. And as an investor, you're kind of scratching your head. Is this good or bad? And ultimately, we're trying to keep our costs low. And so from that perspective, it's not that great. So it's interesting because I find that, it comes down to this whole concept of strategy. And, people, it's kind of the life cycle of a strategy is good. An investment strategy is good until it isn't good, until it stops working, or it isn't good until a whole lot of people get on the bandwagon and start copying you and start doing the same thing. And it's interesting because we're kind of seeing this kind of thing play out here, where you have people who, I'm just basically talking about sort of the life cycle of an investment strategy, and often it starts off with a small little place, a couple of people, a boutique kind of organization, developing a model, developing a strategy. It starts working. People start hearing about it and they say, hey, I want to get in on it, or I'm going to copy it and do my own version of it. And so then all of a sudden you got a lot of people adopting the same strategy. And then all of a sudden those assumptions in which that model was developed by don't work. And then the strategy falls down and then people lose money and get upset. So it's interesting when Wealthfront marketed this advanced indexing product or service that they've got, they based their, excuse me, they based their pitch really is that they back tested this thing like over 50 years, and on average they were outperforming the index by 1% a year over that 50-year period. And again, it comes down to this other sort of takeaway with respect to strategies is that past performance, just because it worked in the past doesn't mean it worked in the future. And a lot of times when you see like these companies talk to you about, well, we've back tested this strategy, investment strategy over 20 years, and this is the return we generated. Well, a lot of times that back testing was done in a very perfect kind of world, and maybe they accounted for all these different variables, but a lot of times with these investment strategies and these investment models, they don't model everything and they can't take everything into account. And if that was the case, then we would have never had the financial crisis. We would have never had a subprime meltdown. We would have had any of that garbage. It would have been modeled in, but it wasn't. And that's the limitation, again, with strategies. You have to take them with a very big grain of salt, especially when you hear the concept of back testing, because, yeah, you want to see if there's some demonstrated competency behind doing that. But to assume, well, it worked in the past and that means it's going to work in the future is a pretty dangerous thing when it comes to investing. And that's where it feeds into one of our behavioral biases that I like to talk about, which is recency bias. Just because the stock market, the S&P 500 went up 20% last year doesn't mean it's going to go up 20% in the future. You have to have an open mind with respect to how you look at these strategies. And that's the key thing that comes. So at the surface, I thought it was sort of an ironic moment where this gentleman who was the father of passive investing is saying, may not be that great a thing anymore. So I'm wondering if that's kind of is this sort of that jump the shark moment for passive investing? I don't know. Maybe it is, maybe it isn't. But really, the second level thinking that I was kind of thinking about this was that strategies, you're going to see there's all kinds of investing strategies out there. value-based, growth-based, technical analysis, behavioral analysis, literally the eye test where people just go and meet people and make decisions based on the type of governance and management style that are out there. The key takeaway for investors is, for us, is there is no magic strategy. There is no holy grail of investment strategy. This advanced indexing strategy may be a useful thing, but it's not by no means the defining investment strategy you need to consider. You have to look at your plan, your strategy, your goals in your life, what you need to earn, and then adopt a particular strategy that you're comfortable with to meet your success. And so there's no magic strategy out there. Second thing that's a takeaway for me is, because of that, you need to open your mind to all different kinds of concepts. And whether you believe in actively managed investing or you believe in passively managed, you need to kind of be willing to embrace ideas from both sides. Because investing is a process. And I can tell you from my personal experience, the way I invest, my core ideology is very much the same, but how I go about investing, the strategies that I use ETFs, and I do buy individual stocks because I think there's merit in both of them. I think there's value, there's opportunities to make decent returns through both mechanisms. So I just have to be aware and be open to it and not just be, well, I don't believe in ETFs, so I'm not going to invest in ETFs. There are people out there that are like that, and they're going to pound the table on that, and they're going to say that their way is the best way. From my experience, the people that really know how to do this stuff really well have very open minds and are willing to embrace different ideas and strategies and perspectives in how they make investment decisions. And the third thing that really that's important too, that it's a takeaway, is whatever strategy you're looking at, just don't take it because somebody back tested it 50 years and it works and it worked. You got to look under the hood and you got to do some due diligence on it and see what kind of investing that was done, what kind of assumptions were made, and ask questions. And if you don't understand the strategy, well, then you probably shouldn't be doing it. But then if you're working with an advisor, you're working with a bank, somebody in a bank, or working with somebody in a mutual fund company, ask the questions if you don't understand. Look under the hood, ask the questions, because this is your money and you want to make sure you're making good investment decisions. So I found this really interesting. At first, as I said, I thought it was quite ironic and kind of a aha moment in a sense that the father of index investing is basically kind of throwing it under the bus. But at the same time, and then basically going to join another company and has basically endorsed another company's product and strategy to push that. But to me, the big real takeaway from this article was just the whole concept of thinking when you're looking at investment strategy to really be an open mind on it and not just get centered on focusing on one type of thing, and kind of having that confirmation bias and just something that you believe in and just sticking with it. Embrace all ideas, embrace all concepts. And that's what I teach people that I work with how to do. So if you have any questions about this, feel free to ask, send away. If you want to weigh on it, tell me if I'm full of it. Tell me if I'm, where you agree, disagree. It's all good. Let's have a convo on it. You can hit me through my website, sageinvestors.ca. You can just drop an email through there, and I'd love to hear from you. You can hit me through my Twitter account. My handle is @sageinvestors. I'm on there all the time, kind of just tweeting away my personal investment decisions in real time, but also sharing with you what I'm reading, what I'm kind of thinking about as I'm formulating my own investment decisions, and my observations, what I'm seeing, what's going on in the market. So you can follow me through there. Feel free to do that. And sorry, just want to announce also that I've recently created a Facebook page, Sage Investors. So just do a search for there, jump on board. I post all my blogs, blog updates, links to my blog updates, podcasts, videos, and also all articles that I'm seeing and I'm reading as I'm formulating my own investment decisions. So feel free to jump on there and feel free to like, follow, I don't know what else you got to do on Facebook. So that's just brand new, spanking new. So love to hear from you. You can ask me questions through there too. I'll be happy to guide you and answer whatever you got. So that's all I got for you this week. This has been another episode of Stock Talk. My name is Aman of Sage Investors. Thank you for joining, and feel free to subscribe to any of the other podcasts. They're on iTunes or through my website, sageinvestors.ca. And we'll catch you again another time. Take care. Bye-bye.